That portfolio on your screen: career, health, marriage, network, sleep. Total value: roughly 7.2 million over a working lifetime. You have never priced a single position. That is costing you everything. You think thinking like an investor means picking stocks. Wrong. Stock picking is the smallest, lowest leverage thing investors do. The actual skill is allocating scarce resources under uncertainty. You have been doing that since you were 16, badly. That ends today. I spent 6 months reverse engineering the public memos of Howard Marks at Oaktree, Charlie Munger's 1994 elementary worldly wisdom speech at USC Law, and the cognitive bias work of Kahneman and Tversky. Conclusion: elite investors do not outperform on information. They outperform by applying 5 mental frameworks to every decision. I am an educator, not your advisor. These are decision tools, not stock tips. Framework 1. Expected value, not outcome. Most people grade decisions by results. Investors grade decisions by process. The difference compounds over a lifetime. Every decision is a probability-weighted bet. Take a job at a startup with 20% equity. Best case, 30 million payout. Probability based on Cambridge Associates venture roughly 4%. Expected value of the equity, 1.2 million. Versus a corporate role at 400,000 total comp. Probability of receipt, 98%. Expected value, 392,000. The startup wins by 3x on expected value. But, and this is where most people break, variance matters when you are a single agent who cannot diversify. You cannot run the experiment 1,000 times. You run it once. Applying this forces 3 questions before any major decision. What are the actual probabilities, calibrated to base rates? What variance can I tolerate at this stage? What is the expected value over a 10-year horizon, not a 1-year snapshot? You might say you do this in your head. Kahneman and Tversky's work is unambiguous on this. Humans systematically overweight vivid outcomes and underweight base rates. Calibration requires writing it down. Most 6-figure earners I have spoken with, and I have run this exercise with around 40 of them, could not articulate the base rates for their own career bets. They knew the upside. They did not know the probability. The fix: before any decision over $50,000 or 6 months of your life, write down 3 numbers: probability of best outcome, probability of base case, probability of failure. Calibrate to public data, not your gut. Most people who do this stop making roughly 40% of the decisions they were about to make. That is not paralysis. That is intellectual honesty. Quick check. When was the last time you wrote down the probabilities before a major career move? In your head, does not count. On paper, calibrated. Drop a yes or no in the comments. Honest answers only. Framework 1 is the easiest. Frameworks 2 through 5 are where most high earners discover they have been making decisions like amateurs. You might be thinking, I already understand risk-reward. I size my positions. I know the math, maybe. But asymmetry is not about risk-reward abstractly. It is about structuring your life so small bets have capped downside and uncapped upside. Nassim Taleb calls this the barbell. Load most of your capital, financial, time, reputational, into low-risk, predictable positions. Then, take small, frequent, deliberately convex bets where the worst case is bounded and the best case is not. Apply this to your actual life. 85% of your time into the high-stability core: job, health, primary relationships. 15% into convex bets, side projects, content creation, angel positions under $5,000 tickets, high-leverage skill acquisition, networks outside your industry. Look, let me level with you for a second. I built my career inverted on this. A decade of pure W-2 stability, 0 convex exposure. The bill came due. Do not repeat it. Most high earners make the opposite mistake. 98% in the predictable core, 2% in mediocre middle risk activities. Same golf foursome, the second beach trip, scrolling LinkedIn. No convex exposure at all. NBER labor data shows the top 0.1% of earners overwhelmingly built equity in projects outside their employer. The W-2 alone does not get you there. The convex bet, compounded 15 plus years, does. You do not need more risk. You need to relocate your existing risk into asymmetric positions. But here is the catch with investor thinking. There is exactly one domain where applying it actively makes you poorer, and I have watched high performers destroy themselves running expected value calculations on it. I will resolve that in 90 seconds. Two people, same income, same starting point, different mental architecture. James is 42, senior director at a Fortune 500, 400,000 total comp. He grades every decision by outcome. The vacation was worth it because it was relaxing. The MBA was worth it because he got promoted. He has never written down a probability, never inverted a decision, never categorized his time by convexity. Daniel is 43, same role at a competing firm, same comp. Daniel runs every major decision through 5 filters: expected value with calibrated probabilities, asymmetric downside. Second level thinking. What does everyone believe, and what is mispriced relative to that? Inversion. Margin of safety. 12 years in, both earned roughly $4.8 million in W-2 income. After tax, identical. Daniel's net worth at 43, $3.6 million. James's, 1.1. Same job, same earnings, triple the equity. The delta is not investment returns. Their S&P and bond allocations match almost exactly. The delta is decisions outside the portfolio. The car James bought, the MBA James debt financed. The convex bets Daniel made, and the ones he refused. Same money, different operating system. And the catch I promised. The one domain where this destroys you. Daniel learned it the hard way in his 30s. He ran expected value math on his marriage, on friendships, on his relationship with his kids. Transactional optimization stripped every one of those domains until he stopped. Investor thinking is a scalpel. Pointed at capital, time, career bets, it builds wealth. Pointed at love or community, it strips them. Know the boundary. The system, 5 filters. Run every major decision through them before you commit. 1. Expected value. Calibrate probabilities to base rates, not narrative. 2. Asymmetry. Cap your downside. Engineer for uncapped upside. 3. Second level thinking. Ask what everyone else already believes. Then ask what is mispriced relative to that consensus. 4. Inversion. Pre-mortem. Describe the failure mode in detail before you start. Avoid the most common path to failure. 5. Margin of safety. Plan for the world to be 20% worse than your projection. If the decision still works at -20, proceed. If not, walk. 5 filters. 20 minutes per major decision. That is the entire framework. You are already an investor. You have been allocating attention, time, reputation, and energy for 20 plus years, most of it unintentionally. Become the type who allocates with intent. The 5 filters give you the decision framework, but filters tell you which bets to take, not how much to allocate to each. That is position sizing, the next blind spot. The Kelly Criterion adapted for life capital. How much time, attention, and money each bet deserves given the probabilities you just calibrated. That video is in the description. The personal allocation worksheet is there too. The calculator that runs the filters against your actual portfolio. Open it. Build the model. That is the next move. Whew.